Good afternoon, everyone, and thank you for joining us on today's session on taxation and accounting within the digital economy. I want to thank the Chamber of Digital Commerce for hosting us. My name is Nick. I'm a reporter with CoinDesk, and I'll be moderating our first panel. I'm joined by Wendy Walker of Sovos and Peter Larson of Deloitte. And let's I think let's just jump right into it. It's been a busy couple hours, busy day, and it's a lot to talk about. So, first session, we're talking about taxes and information reporting, and I guess the big news right now is the bipartisan bill that has been introduced or proposed uh, within the infrastructure team in the U.S. Senate, and it seeks to raise some $28 billion through improved enforcement of information reporting requirements on crypto transactions, but also seems to expand the definition of brokers, or rather, those who are handling these transactions by quite a lot. And Wendy, Peter, just want to throw it to you. Maybe get a quick for initial thoughts on what the implications are of this bill if it passes as proposed.
I can jump in, Peter,
Go
first if
ahead.
you like. Well, I mean, I definitely think that's the key, right? Is that if it gets passed, I definitely always say to people this we're in the negotiation phase, so certainly some version of this will come through. But I will say that working with the Digital Chamber, working with Peter and some of my other colleagues on the tax task force, there we have identified a number of areas that require tax guidance, and the bill that we're seeing circulated right now are some of those provisions. I mean, there's just a lot of clarity missing, right? And I have particularly found it interesting. I've seen that there is maybe an inclusion for decentralized or DeFi, marketplace and P2P marketplaces, and I was very surprised, as this is an area that clearly they don't even have necessarily the information needed for information reporting. So I'm wondering, definitely wondering how some of this will play out. Peter, I don't know, what are your thoughts?
Yeah, well, I agree. There's still still kind of early days. We have a proposed bill, and there's been some drafts of it flying around that we're able to look at and sort of speculate as to what a year or two or three from now, when the reporting actually is required, what folks are going to have to do. And with information reporting, the devil is always in the details, right? What data do you have to collect? What transactions do you have to report? How what's the volume? That's where the big impact is, and then how does that trickle down actually to an investor or someone who a consumer, however you want to view the folks who have the tax implications from the digital assets, how they're going to report that on their return. I think there's a lot of that needs to be, we're a ways from that. However, the text of the bill, as that I've seen, does put a lot of clear discretion to the secretary, to the Treasury, to issue guidance. And I guess that's what's maybe interesting about it, is it has some very broad language that it's really hard to look at right now and know what it means. But I think it does give, we had Commissioner Rettig saying, maybe we need legislative action before the Treasury can really issue regulations or guidance. So maybe that's one takeaway, is there may be, this is step one, and if this bill passes, it's step one, but there's going to be a step 2, 3, 4, 5 of additional follow-up needed to really get clarity and provide the clarity the industry's been looking for. But at least, maybe the secretary, that'll be something the Treasury can do through its rulemaking capabilities.
It's a great point because, just from a 1099 reporting perspective, I've been to a couple of industry events over the last few months where Chief Counsel's office has attended and spoken at those events, and they have an active reg project open for, preparing 6045 guidance. So to see legislation in this bill that is a bit cryptic, so to speak, I think is probably, to your point, Peter, just to give them some broader authority, in terms of what they've already been working on for the last 9 months or so.
Yeah.
So there's been concern that, in addition to decentralized exchanges and peer-to-peer marketplaces, that this bill, you know, barring any additional guidance that might come out, could also, force hardware developers or software developers, hardware manufacturers, to, start reporting certain details. Do you have any views on, how that would play out? What, how do we get from what we have right now to, uh, these different aspects of the crypto ecosystem suddenly having to report tax information?
I mean, I thought about this a lot actually when I first got involved with digital currencies or digital assets several years ago. One of the ideas that we kind of floated around from an information reporting perspective is, hey, why can't we embed the information reporting information, the tax identification information needed for information reporting into digital assets, so that you don't have to go through this painful onboarding, data collection, paper process that banks, financial institutions have to go through today. And I think there's a view in the industry. The industry is very innovative, right? And there are some people in the industry who are thinking about how can we bring information reporting into the digital assets so that it's an easy thing to do, and this burden that might be imposed by the regulation or by the bringing in hardware makers or other people who could be affected by broad language, right? There might be technology solutions out there that make this easier, and the industry could always adapt to this. Now, having said that, is that good policy? That's a completely different question, right? And I do think, it raises a lot of questions about what impact will this have. These are U.S. laws, right? That would squarely impact U.S. businesses who are engaged in, providing services or hardware, right? The information reporting rules do have a reach outside the US, but it's less effective, both in terms of an enforcement, and sometimes the rules apply differently outside the US. So clearly they would have an impact in terms of how US based, businesses engaging in in digital asset technologies will be impacted by information reporting burdens that would be different outside of the United States.
I think it's not just the payers that it's trying to trying to bring into scope. I think it's also the lack of clarity around the assets that are in scope here, because the way the language is written currently, all digital assets would be brought into this. And I, kind of am concerned, for example, for NFT marketplaces. There's an argument to be made there that, that's a different type of tax treatment than, or at least some of those transactions are a different type of tax treatment than trading income, so to speak. So I do think that goes back to that discretion piece that Peter mentioned. But yeah, one thing I will say, that's interesting about what you said, Peter, is I think about traditional market and how we onboard, we collect documents, but not only that, there's a lot of intermediaries in between, and there's more documents and withholding and reporting that goes on all the way through that chain. And to your point, isn't there a better way to do this? So it'd be great as if the Treasury does have that broad authority for them to really be thinking about that. Why do we have to kind of fit the square peg round hole situation here? It'd be great if we could, be more forward thinking about how we administer this process longer term.
It's a good opportunity to segue into where what we're looking at right now. The big complaint has been, of course, that there's not nearly enough clarity around digital asset taxation. And what clarity there is, you have obvious issues such as, there's no de minimis exception. So, what do you see as the kind of, the big glaring issues that we're looking at right now? And is that the same as it's been for the last couple of years, or are we seeing, new issues pop up as NFTs and DeFi really take off?
Well, yeah, I mean, I think every iteration of technology and ideas that come out in the digital asset space presents new questions, right? When we were first just looking at Bitcoin a couple years ago, right? Now in retrospect, it seems much simpler than when you're looking at an NFT and trying to figure out, okay, is this royalty income? Is this a sale of property? What's actually going on in the marketplace? So I think we're going to continue to see an evolution in this space, and the questions are going to constantly change. And I think that's one of the challenges that this legislation faces, right? Is we really don't know in a couple of years what is going to be popular, what's going to be useful, what's going to be what will people adopt. And DeFi presents a fundamental challenge to the information reporting world that we've been in, that's been so effective at making the US tax collection system effective. It depends on having middleman or banks. It's pretty clear there's a payor, that someone's making a payment, and that's the person who needs to do the information reporting. In the DeFi context, you're trying to take away those middlemen. You're trying to take away, actors who have a clear role, clear custody, clear control of a transaction to do information reporting. And so it's the fact that the draft legislation includes a potential hook to try to bring DeFi into the scope for reporting. it would have to be really broad. And I think, the language is drafted very broadly. And there's a lot of questions on how that would play out. Not only would you, is the language so broad, not only do you have a problem of bringing, a lot of people into scope, you bring a lot of people into scope, you start having to figure out, well, who amongst all those people has to do the reporting? Very easily leading to duplicate reporting. If two people see themselves as having the role of doing reporting and both do it, that's not a good answer either. So there's a really big challenge with information reporting in DeFi.
I would say from a gap perspective, certainly the age-old conversation of the trading income, and we have 1099Ks versus 1099Bs, and so we have a different treatment happening on the back end from the IRS's perspective. And so, my clients are really looking at, potentially the 1099B regime coming their way, in the near future. And so what does that mean? And so taking that apart in terms of, when is a cryptocurrency a commodity or a security, right? Or not, or none of those things. When is a payer for information reporting purposes and withholding purposes? How do we value crypto, right? How do we, because about 3 to 4 weeks ago, I was purchasing some new tokens on Kraken because I could get that token cheaper than I could get it on Coinbase, a lot cheaper. And so there's, I believe, arbitrage, a real opportunity for arbitrage in this space because of that fluctuation. The IRS currently tells taxpayers just to look up the fair market value, and they aren't real clear about what's a reliable source, right? And so I feel like there's a real lack of clarity in both the control of the valuation of the asset, but also in, just what's acceptable and what's reliable. And that transcends to payers putting it on a 1099 form, and then that transcends to taxpayers putting it on their 1040, and on down the line. So I think those age-old gaps are still there, but I think there are new gaps, like not just DeFi, but I think staking rewards are a really interesting one to talk about. I think that recent lawsuit by that couple from Tennessee to the IRS around, whether or not their Tezos rewards should be treated as ordinary income or taxed upon receipt, as opposed to when they, actually dispose of the asset. And, I think we've heard about that debate a bit in the industry, but now it's rising to the point of, litigation with the IRS. So I think there's new issues because the ecosystem is evolving, but I think everyone's sort of like, if we could just get the age-old issue of trading income addressed first, then maybe we can help pave the way, for additional guidance of these other issues.
Yeah. And I don't know that the legislation addresses that age-old question, right? To some extent, it was interesting in the draft legislation that it seems to jump ahead to some of the more complex issues without addressing some of the issues we've been debating about, for the last 5 or 6 years. Maybe that will be addressed in pending regulations from Treasury, right? Hard to say, but the draft text of the bill doesn't really address those issues, those fundamental issues.
It's a great point.
Yeah.
And so I think when I looked at the text of the American Families Plan, that, in there, of course, there's some proposals for tax reporting in there for crypto exchanges, more around, of course, we have that financial account reporting, which is a bit different. That would be like a whole new regime for everybody, banks and the like. But there's also that separate piece for broker reporting around crypto assets that seems to be looking at maybe offshore and FATCA reporting coming that way. But to your point, you talk about what's in the infrastructure bill, and then you talk about what's in the American Families Plan, but in neither of those does it answer a lot of these age-old questions. So I'm reading my tea leaves, and I'm saying perhaps that is why, because they've already maybe got some of this, being penned and have been working on it, as we know, since last fall.
So just a quick aside then, is it even possible, do you think, to fully address these more complex questions without, fundamentally addressing that initial trading question?
I mean, without a foundation for the fundamental question, right? I don't think you can really get into the more complex questions. And I think to Wendy's point, yeah, it seems like maybe Treasury IRS have already a point of view about the fundamental questions. They're just waiting for the right moment to issue regulations. I don't know. That's really speculative on anyone's part, but that could happen. And maybe they will address those fundamental questions. And as they do, right, that will provide a foundation, I think, for addressing some of the newer questions. But I mean, this is a challenge, though, right? Like, I mean, we do not know 4 or 5 years down the road what the economics or the incentives that will be built into new digital assets, and it's a hard challenge to create a framework that is going to adapt to those in the future. Not only, I mean, that's a fundamental tax issue, right? Information reporting is always, in my mind, a bit harder than the fundamental tax questions, right? First, you have to establish the basis for how people are taxed, when they have gain, what's the character of it, right? Then you can start answering the information reporting questions. But that's the challenge that exchanges, other players in the industry face, is that they need to, for them to comply, the foundations need to be there. Otherwise, you can't decide when or whether you have to report. It's a different analysis to figure out when I put something on a 1099 than if I'm just a taxpayer, how I recognize gain or loss.
And, building on that, the problem that we have, and we've continued to have for a few years, I kind of go back to that 1099K versus B situation, is that because they don't have guidance, and instead they receive John Doe summonses, right, for information. And so they want to report. And so you find the industry, some of them deciding to report that 1099K, some of them deciding to report the B. And downstream, what you find is this mess occurring for the taxpayer and for the IRS, right? So the 1099K is meant for business income tax returns. And so it causes them to issue these penalty notices, and these taxpayers are then trying to explain and articulate, their gains and loss income. And so fundamentally, it goes back to what Peter's saying, which is that we need the initial baseline here to be established. Then from there, we can ask a lot of those clarifying technical questions that get into the implementation of information reporting, because the practical nature right now, we can't see the forest through the trees, so we really need that basic, baseline, I think, in order for us to build the rest of the process here.
And I do think the fact that they're saying digital assets are covered securities in the draft bill does provide some of that clarity, right? It does seem to suggest 1099B is the way to go, right? It makes that a little bit clearer. But which transactions get reported, right? Is it any transfer? Is it a peer-to-peer transfer, right? And again, there's room in the legislation to allow Treasury to interpret that, but it's going to maybe a while before we actually get to the specifics.
Yeah.
So that brings me to enforcement. This is an issue we've seen, around the regulatory industry. With regard to crypto, the SEC always has this issue where, people complain that it's all regulation by enforcement. The IRS has, as you mentioned, brought forth those John Doe summons, and, brought forth, some other enforcement actions. Do you feel like we're going to see more enforcement actions before we see these firm regulations, or is your sense that the IRS is working on, providing clarity, providing some information before they continue an enforcement regime?
My sense is they're going to continue enforcement. I think that part of the problem here is that without any information reporting regime on the horizon, even if they release regulations, let's say best case scenario, end of this summer, we get some proposed 60/45 regs. This isn't even the infrastructure bill I'm talking about, just, what they've been working on for the last 9 months. So let's just say we get something by the end of summer, we have to go through a public comment period. The industry will provide lots of technical feedback and questions. The IRS will probably have to go back to the drawing board somewhat in Treasury before they can issue something final. I say we're lucky if we get it by January, end of year to January, right? But from there, there's an implementation period. A couple of my peers, in the industry have said it'll take them 18 months to get their systems ready to track cost basis for this. So that's just to track cost basis, not actually report anything, right? So I think that there's a long implementation period period. And I say all that to say that means a lot more years of no information reporting potentially, right? And that means the IRS needs to continue to try to get that information. And the way they've been getting that is through John Doe summonses and through, the checkbox on the 1040. So I'll bring that up and say, the IRS recently published a draft form 1040 that has for tax year 21, that has the crypto question there on the front page. They've modified the question yet again, kind of clarified it to hopefully take out the idea that if you've simply acquired crypto or you've sent it to someone that you don't necessarily need to check the box. But, the idea that they're continuing to modify and keep that question there, recent enforcement actions with Circle and Kraken this year, yeah, I would say that this is what's on the horizon. Unless the only thing I've said to folks in the industry is unless they feel like there's an opportunity to require a gross proceeds reporting in advance of cost basis reporting for trading income. That, certainly could be a possibility that could happen sooner than that 18-month thing that I mentioned, but there's certainly still, the industry needs time to get their systems ready, get their documentation ready. You don't just come out and report 1099 information, right? There's a myriad of deep penalties that are associated with not having correct tax identification numbers. There's withholding tax implications. So you don't just come out reporting 1099s. And so again, I think because of that implementation period, we're going to continue to see this enforcement thing while we wait for the regulations.
Yeah, and I
Gotcha.
think
And then,
go ahead.
Sorry, real quick. So we're coming up on about 20 minutes in, and I do want to give the audience a chance to ask some questions. So if you're watching this, please, send some questions into the chat, and we'll start taking a look at those in just a few moments. But yeah, I did want to get that note out there. And then Peter, you had something?
I was just gonna say, it's, if you look at how FACA, the Foreign Account Tax Compliance Act, rolled out, the laws were passed in 2010. I think the first bill was introduced in about 2008, and they finally got to an agreement on it in 2010. The effective date was pushed back. I think eventually 2015 was really the first year that it really kicked in. And then, in 2020 was the first time we really saw the IRS sending out matching letters, right? What we got from the financial institutions doesn't match what you put on your 8938 on your tax return, right? Can you explain it? Sort of soft enforcement letters. So that's, a 10-year period before you started seeing information reporting style enforcement. But however, during that whole period, the IRS continued to pursue, through the Department of Justice, chasing down folks who had offshore accounts, right? Still having voluntary disclosure programs. So there we saw a parallel, as the information reporting regime and frameworks developed, and they're probably still being developed for FACA today, we still saw enforcement through, the department, through the IRS's offshore enforcement program through that 10-year period. And I suspect it'd be the same with crypto too.
Right. So I want to move to, also see if we can get some actionable information for the audience out there. What are the biggest, issues you see? What's the biggest gap between what people think their information reporting obligations are and then what those obligations actually are? Are people just, is it a cost basis issue? Are people just not reporting everything they should be? Where do you see the biggest holes right now?
I think the biggest, this is maybe a little bit my opinion based on conversations with people in industry, is I think, there's currently in the 6045 rules, the rules where the proposed legislation is being impacted, there's currently rules that say certain types of commodities should be reported on 1099Bs. And there's a barter exchange notion. If you set up an exchange to facilitate trades of property, there should be 1099B reporting. And I think a lot of people are really honestly curious, should those rules already apply without further legislation and without further regulatory action to transactions happening today? And there's clearly an argument that, to me at least, that there's argument that those rules should apply. But there's also good arguments, these rules were created 20, 40 years ago that didn't contemplate crypto. I think there's good arguments to say how enforcing those rules would be messy, right? But it would be nice to just get that. I think a lot of people, that's their fundamental question. Let's answer that first. And that's I think the topic you seem to talk about the most.
It's a great point. It's a security versus commodity debate, right? It's like, and the CFTC has said, they believe that Bitcoin and ETH is a commodity. And so, presumably then does that mean there at least is a gross proceeds requirement under 6045 for exchanges to report 1099s? I mean, that, and to your point, like many of us who've been in the industry for a number of years, it's like, it's probably our personal opinion that that's the case because we haven't really seen anything, around, but I'd say a lot of people will come into this that are working in the industry. That's one of their immediate thoughts. The other thing I would say is, for example, here recently we saw the chief counsel memorandum around the 1031 exchange rules, right? And the prior years, prior to the change from the Tax Cuts and Jobs Act, and that their position is that, exchanges with Bitcoin and necessarily may not necessarily have been 1031 applicable. And so I think that that is an area for me that, just watching that play out so many years after taxpayers have already filed their tax returns and 1099s have been issued and all that, and just to come out with something like that, even beyond typical statute, right? And typically you would go back 3 years and make adjustments to return. So it's just interesting to me that we're getting clarity so long after people have filed information, and it's really, really harmful. And so I would say that a really big gap would be around like a VDA. Like, can we, there's got to be some opportunity with some of the, as they're learning more and more about how crypto works and how the different tokens use cases operate, and then how that impacts tax. There should be a bit of a safe harbor here, for not only for business filers, but for taxpayers, to sort of shore things up here. So.
Gotcha. Okay, so we're getting some audience questions. Let's treat this as a lightning round because we have quite a few. First question, how are airdrops treated when it comes to tax? And Wendy, let me toss that one to you.
Yeah. So right now, because of the Rev Rule 2019-24, right, and the FAQs that we have, we understand that the IRS treats them as taxable upon receipt. So when you have dominion and control, when you have control of those assets in your wallet or in your account. So there are scenarios I know where some exchanges, you might know that you're going to receive a reward, but there's like maybe a certain day period before the assets are actually deposited into your account. So that's why I mentioned the control aspect. So yeah, it's taxed upon receipt, which is why I was mentioning earlier, there's a challenge right now to the IRS from a couple around whether or not they should be taxed on receipt. Perhaps they should be taxed when you actually dispose of them as opposed to when you receive them.
Right. And Peter, let me throw this next one to you. As an individual investor, what are the best resources to use to ensure I'm tax compliant?
Well, that's a tough one. I think the first thing I would say is look at your exchange or the platforms they're using and really take advantage of the information that they provided. Despite this uncertainty Wendy and I have been talking about what you have to report, I think most of the exchanges are very interested in getting good information, getting good customer service, and a lot of them have invested and developed in providing tools so that you can keep track of things like, what was your cost basis in an asset, so that you can take that information, give it to your CPA, bring it into TurboTax, whatever, and help get it right or as close to right as you can. So I think really study the information that's available to you is probably step one. And then there's other vendors out there and things that can take that information and help you do the hard work of figuring out what your gain or loss is.
Cool. And then our final question, what international coordination is going on, such as the OECD or other bodies, or is it just the US that is enforcing these taxes? Is the US behind, or is it a leader?
The U.S. is behind, I think. There are, I would say that most of the G20 countries have agreed that crypto is property for tax purposes, but there's, everybody taxes things differently in those different jurisdictions. So the OECD has been working for quite a while longer. I feel like I've worked on that issue longer than the IRS issues, where they've been trying to modify what's called the Common reporting standard, the CRS. They've been trying to get the member countries to agree as to how that information should be reported. Interestingly, we'd expected to see guidance from the OECD on this earlier this year, but I understand that they specifically postponed releasing that guidance in anticipation of the US government releasing their regulations, presumably what we're seeing not only in the infrastructure bill, but in the American Families Plan. So I think that, they've been ahead, they're waiting. I've heard now that Q1 2022 is when we'll see potentially a change to the draft change to the OECD schema and the CRS requirements. So I'd say that's one. Other governments, though, I think also have done some, similar to the IRS, I think in the UK, and Peter, maybe you have more know about this than I know more than I do about this, but as some of my clients have mentioned, almost like a John Doe summons type of process where the exchanges operating in those jurisdictions have received requests for prior year tax information from exchange clients in those jurisdictions. So.
Yeah, there's definitely a couple of countries globally that are already have frameworks that allow them to go request information about digital assets that I think there's rumors that those have been used, I guess. The UK, Australia is another example of a jurisdiction like that.
Gotcha. Unfortunately, we are at time now, and we have to hand it over to the next panel. Thank you, Wendy and Peter, for joining me, and thank you to the Chamber of Digital Commerce for hosting this. I'm going to hand this over to Dave Schofer, who will moderate the next panel. The floor is yours.
Nick, thank you. And to the panelists, and Nick, great job discussing the tax issues that are out there. Fantastic information. Thank you. My name is Dave Schrepfer. I am a financial services partner with Wipfli CPAs and Consultants. I specialize in the cryptocurrency services, digital asset sector of the firm, and serving clients that are in the digital asset arena. And I am pleased to be joined with three very, very knowledgeable experts today. And let me start with Michael Marzelli, audit and assurance partner with Deloitte and Touche LLP. Michael is a partner in the financial services audit practice and a leader in Deloitte's blockchain and digital asset audit practice. He has more than 15 years experience serving a wide range of clients, from emerging growth companies to multinational organizations in New York, Hong Kong, and San Francisco in both audit and advisory capacity. He has broad experience in serving clients in securities, banking, fintech, and digital asset space, again, focusing on audit and assurance methodologies. Also, we are pleased to be joined today with Lizzie Fallon. Lizzie serves as a legislative assistant in the United States House of Representatives, managing Representative Tom Emmer's Financial Services Committee portfolio and specializing in policy related to fintech and blockchain and crypto. Additionally, Lizzie manages the members' co-chair responsibilities on the Blockchain Caucus. And prior to joining Team Emmer, Lizzie was working at Parkhurst Energy in Houston. She's a member in National Political Science Honor Society, Phi Sigma Alpha, and she has served as the president of Columbia University College of Republicans. Last but not least, we are very pleased to have Noah Buxton, Managing Director, Practice Leader for Blockchain and Digital Assets in Armanino. Noah has more than 10 years of audit, legal, IT, and regulatory compliance experience. Noah leads Armanio's blockchain and digital asset practice. His expertise lies in IT and security matters, as well as financial assurance and reporting for virtual currency exchanges, security token issuers, broker-dealers, blockchain and cryptocurrency startups. Noah was part of the founding and formalization of the blockchain practice. He also serves as director of product for the Trust Explorer and Blockchain Lab. So again, to each of you, welcome and thank you for participating in what's going to be a very interesting and hopefully a lot of knowledge in the digital asset accounting world. So kicking things off today, I think let's start with where we are today in terms of accounting on digital assets. So I guess the first question for the panel is, what are we currently seeing in terms of accounting for digital assets today in industry? Michael, you want to start us off on that?
Sure. Thanks, Dave. Yeah, so what I've seen in the last year has really been kind of an expansion of the use of digital assets, and really a lot of public filers considering the use of digital assets. Up to the last couple of years, it's primarily been in the private space. A lot of companies, startups using crypto assets, but the proliferation over the last 2 years has really kind of put a focus on some of the challenges around accounting in this space, primarily around the treatment of certain crypto assets like Bitcoin and Ethereum as intangible assets, which in a lot of cases creates a situation where the use of those assets really doesn't line up, and the accounting for those assets doesn't really line up with the economics that these companies are using those assets for. So it has kind of brought to a head the importance of thinking about specific accounting in this space.
Thank you. And Noah, anything to add onto that in terms of your experience?
I would agree. I would say also generally I would say it's a landscape fraught with uncertainty for most operators in this space. As I've said before, I think most people in this space, certainly the folks that we deal with at Armanino and our clients, are always trying to do the right thing. I think they're up against sort of operational hurdles and things like that. But one of the biggest things they face is uncertainty. And that's definitely true with accounting treatments and bookkeeping matters for digital assets. Yeah.
So specifically, and for any of the panelists, what do we anticipate today expecting to see in a financial statement as far as how those digital assets are accounted for? Any comment on that?
So the first step, typically with looking at digital assets, and they're not all created equal, is kind of determining what is the nature of your digital asset. Is it, would it be considered a prepaid asset? Is it really considered a security? Is it an intangible asset? And many of the popular cryptocurrencies, unfortunately, fall into that intangible asset model. But once you determine the type of asset that you're transacting in, then it's just following the existing GAAP and working through the standards as written currently to determine how the transactions that you're making are then accounted for. And that becomes particularly tricky as we've seen a lot of innovation in this space, a lot of new products that are being rolled out, particularly around lending, staking, some DeFi products, where the complexities plus some of the challenges with accounting for intangible assets don't always line up and make for very challenging evaluations under the accounting rules.
Great point. And any differences we see between public and private entities, SEC filer versus a private company? Is there any differences in GAAP right now between those two worlds?
I can take that one. I'll take a first stab anyway, Michael. I mean, GAAP is GAAP, so it's consistent between private and public companies theoretically. Certainly, public companies are held to reporting standards and audit standards, and that's really where the difference comes in, right? For instance, a small crypto startup who's launched a token, utility token for their ecosystem, certainly should account using GAAP and should try to and maintain their books that way. Certainly, if they're producing audited financial statements for their investors as well, or equity investors, but if it's a public company, they're really just held to a higher bar, right? An independent auditor has to agree on the accounting treatments and be able to audit them. So,
great.
And I'd also highlight that, so for public companies, you also have additional disclosures, whether it be in MD&A and risk factors, liquidity considerations that are not necessarily under GAAP, but are required to communicate the the health of your business to your investors. So just enhanced reporting requirements, but to Noah's point, GAAP is GAAP. So there's really no difference between the two when you're thinking about financial statements.
Okay.
One other piece of context here, just as we're thinking about how accounting standards apply to our industry. I think Michael said not all the assets are created equal. Not all the operating models are created equal either, right? And so understanding sort of what segment or niche that you're operating in is very important, right? Companies, for instance, let's say investment funds focused in digital assets have a unique mix of things going on. They're one, issuing private securities to limited partners and investors, but they're also managing a book of digital assets, which are, either financial instruments or intangible assets, as again, Michael sort of referenced. So, and then you've got token projects, I think are a very unique animal in this space because, they've created in one way or another, there's many ways that this happens, but they've created a unique digital asset that their company maintains a treasury of usually. Sometimes it's a foundation that maintains a large treasury. And so it shakes out different ways, but I would say that, yeah, maintaining a treasury of your own sort of issued digital asset or utility token can be much different than, an exchange business that maintains a balance sheet that may or may not include custodial digital assets. So yeah, definitely matters which space you're playing in. And of course, now we're seeing vertical integration and crossover between service lines and operating models, right? So you're not only now a spot exchange, you're a spot exchange that offers a derivative product and maybe a lending or a margin product. So now you've got many different things going on.
So I guess a quick summary before we move ahead, but it sounds to me, like there's a wide variety of landscape out there in terms of application of different possible accounting models, in many different situations that have emerged in the digital asset arena. We talked earlier about intangible asset accounting. So just as a reminder, I guess, we're still in this world right now where there is no authoritative guidance in black and white yet that dictates the accounting for digital assets, but there is a an intangible asset accounting guidance out there, non-authoritative guidance out there. What are the challenges in applying the intangible asset accounting rules to digital assets?
And maybe I'll, there is a lot of guidance out there around US GAAP. Some of the challenges are, it falls into a bit of a gray area because you wouldn't call a lot of crypto assets cash, you wouldn't call them securities. They don't fall into clearly a lot of certain buckets, which is in a lot of ways why we sort of default to that intangible asset model. Given that complexity and some of those challenges, that was kind of what led to the creation of the AICPA Digital Asset Working Group, dealing with both accounting and auditing to give some guidance to the practice, non-authoritative, like you said, but to try and give some guidance as to how to start thinking about these rules. Now, once you kind of land in that intangible asset model, you do start to have challenges where the economics of, like I said earlier, the economics of the transaction don't always reflect the way you would account for them under an intangible asset model. You're not able to mark crypto assets up to fair market value. And particularly when you're trading, when you're lending those assets, you have inherent mismatches between how you manage your business and how guidance would allow you to account for them under the existing accounting model.
Great. And I guess in terms of uniformity and presentation, and we go back to the previous discussion of the variety of applications out there. Once again, applying that intangible asset accounting model, could potentially, Michael very well put, you're managing your business and you're accounting for it. It could cause some confusion between the two there. In the end, what does the balance sheet look like under the intangible asset accounting model? What do we see?
So typically, what you'll see is an asset with at cost basis that can be impaired, so written down but not written back up. But in the case of a crypto asset borrow, you could potentially have a liability that fluctuates at fair value, essentially at fair value, whereas you have the asset that offsets that that doesn't fluctuate in fair value. So you could have potential inherent mismatches that are created by performing that activity. And it really requires some additional thinking on the accounting side. Can you apply potentially a hedge accounting guidance, which is sometimes a possibility, but it just creates both a lot more accounting complexity, but also communicating to the investors the results of your business, particularly in a public company space, being able to really communicate and tell the story about your business if you don't feel that the accounting accurately reflects how you manage your business.
Right. And maybe a little different from what we see in a lot of some of the segments that we identified before 5-10 minutes ago. It defies the fair value model, which we've embraced in a lot of other accounting application today in terms of GAAP. Changing gears just a little bit on that. So thinking to more at a higher level, what role does Congress have in addressing the concerns that exist in digital asset financial reporting today? Lizzie, you wanna comment on that as far as where do you think Congress sits in terms of their responsibility or their action?
Yeah, absolutely. And thank you for having me. I'm so honored to be here with Noah and Mike and you, Dave, all experts on this stuff. So I'm happy to provide, kind of what I see Congress's oversight role to be in this space. In the big picture, the goal is to oversee the regulators in a bipartisan fashion to ensure that we have streamlined regulation and clear guidance to keep innovation and blockchain and crypto innovation at home and all the opportunities associated with it in the United States. And the general theme is that the regulators, and I'm going to throw FASB in here, knowing they're, independent, not a regulator, but responsible for providing accounting guidance. There's, a general ignorance with respect to the technology and often inaction, which pushes these opportunities overseas. So that's pushing high-tech jobs overseas. That's pushing capital formation opportunities overseas and entrepreneurship opportunities. So like I mentioned, the FASB is the board is responsible to, create accounting standards for public and private companies. And time again, they have refused to take a look at digital asset accounting standards. And just recently in March, the Chairman Richard Jones of the FASB stated that this isn't a priority for them because this isn't, pervasive enough of a space to pay attention to. So that comment came, while the crypto market cap was surpassing 1 trillion, and on the tails of companies like Tesla and MicroStrategy making large crypto purchases, the lack of guidance and the lack of attention to this issue is not going to work to our favor as a nation. So Congressman Emmer, along with a group of bipartisan members in Congress from the Blockchain Caucus, sent a letter to the FASB encouraging them to focus on this issue and providing a use-based model as a potential framework to address this, which resulted in the FASB opening up a public comment period until the end of September 22nd, if anyone is interested in providing comment to the FASB on what their priorities should be and specific to digital asset accounting standards. So big picture, Congress's role is to oversee in a bipartisan way all the different entities responsible for providing clarity so that we can have more widespread engagement and adoption of these assets in the United States.
Well put, and really appreciate again the actions of your office in terms of comment letter or request letter back to FASB for further having them look at this further. Any other panelists, any other comments with regard to what they see in terms of maybe government or Congress action in terms of the digital asset financial reporting?
I can build on that. I think well stated by Lizzie. I would actually maybe pivot slightly to just say what's our industry's responsibility. And I think this is a super exciting opportunity for us to deeply engage in this space and move it and advance it forward in a way that I don't think other industry participants in other industries have the capability to do. I think like Mark Andreessen said, software is eating the world. I firmly believe that digital assets are eating capital markets. This is an absolutely inevitable shift. In hindsight, we will look back and say, well, duh, like, of course, everything went from paper to networked computers and then went from networked computers to the World Wide Web. And then money became native to the internet. Duh, like, of course. And of course, securities will be digitized and public markets will run on in some fashion, digital ledgers. Our own money, we know the digital dollar, right? So I think this is a fantastic opportunity for us to really just look at self-regulatory measures and also, participating and partnering with leaders in the industry to stick our neck out a little bit and say, here's where we think the guidance should be. So like Mike said, the AICPA paper on auditing and accounting for digital assets is a fantastic resource. It's a great start. We had a great win, I think, with the Digital Chamber recently. A lot of us participated in this proof of reserves working group, not an accounting standard per se, but I do think it is an area where you can see that digital assets, just by their character and by their capabilities, are ultimately better potentially than other financial instruments, or the way that they're recorded is more efficient or more powerful. And that sort of stuff, if we can show that to the powers that be and really show that we can advance the industry that way, I think that that moves us forward really powerfully. Like, it's something we need to double down on.
Well put. And I love the, I've used Mark Andreessen's quote before too, and it very much applies to the digital asset world right now in terms of capital markets. A great point. And again, just quick advertisement for anybody viewing this. Again, that comment period that Lizzie was referring to, please take advantage of that to advocate for movement, because like Noah, like you said, this is an outstanding opportunity in terms of foundational movement within our industry. So assuming the accounting profession is moving forward in standard setting for digital assets, what are some of the key issues and concerns that need to be addressed here?
So maybe just a couple things to highlight from a FASB perspective. What some of the challenges with creating guidance in this space is, exactly what I talked about. There are so many different digital assets and so many different use cases out there that creating a standard in this space is uniquely challenging. You have so many things that you have to address, and you have to be sure that it doesn't overlap into existing guidance and kind of change any existing guidance for traditional industries that we're already very comfortable with. So it is definitely it is a challenge to appropriately craft guidance in this space and rule setting in this space, but ultimately that's why it's so important to comment back to the FASB and explain the challenges that each of the individual entities are having in this space. What are the unique accounting challenges that they're running into, and provide some ideas as to how to solve those issues. Think about like Lizzie said, kind of a use-based model. Thinking about how can you create a accounting standard that is specific to this, that solves the issue of sort of a lot of these mismatches or economic mismatches, without kind of being so broad that you struggle with other parts of GAAP or other areas where you don't intend to make a change.
And if you don't mind me jumping in real quick, with respect to the use-based model, the Digital Chamber has consulted with industry and composed a great potential framework that if you guys don't know what we're talking about, the Digital Chamber has sent letters on it. It's definitely on their website, and then it's also included in Congressman Emmer's letter to the FASB. But it essentially it sets out 4 different options that a company can, I guess, claim that they're going to consider their assets, and then they stick with that moving forward, whether that's cash and cash equivalents, financial instruments, intangibles, or inventory. And then one additional thing, financial instruments right now doesn't include digital assets. So there could be a call to include digital assets as financial instruments as well.
Right. And for those of you who are interested, again, I chaired the group that conducted some market survey information as far as how people were accounting for some of these varying types of transactions. And like I say, there's a lot of diversity out there. Understanding it completely drives the whole concept of why the intent of use is so important, and it illustrates the diversity in practice out there right now. So appreciate that. Noah, anything to add on in terms of what you see in terms of the challenges that the accounting profession needs to consider in formulating these accounting standards?
I think that I agree that with Lizzie, the framework put out by the chamber is a great model for understanding. Maybe just some notes from the field. They're not actually directly related to accounting standards, but for those that have joined us that are in the trenches, on the front lines, dealing with high volume transactions and a business moving at light speed and trying to catch up on accounting. You are in the trenches. It's difficult. And a lot of what it is data problems. And, the software space, the ERP space hasn't really kept up for digital assets. And so, current accounting tools or general ledger tools that are out there today aren't really an adequate fit. And so there's been a little Cambrian explosion of folks trying to address these needs with software. And I think there's a number of them that have done a good job. Ultimately, you're going to have to use a crypto accounting subledger for just about everything, unless you have resources to build tools in-house, which frankly, a lot of our clients are also doing. So ultimately, these are data problems. They're high volume data problems. You've got to be able to get the data. You've got to be able to translate it into a form that you can actually use for an accounting or reporting purpose. And you have to have a consistent methodology. So that is one thing around the standards is consistency. Back to the standards, that's very important. Once you've chosen a methodology, you ultimately have to ride with it. And, same for tax, but you got to stick with your chosen methodology.
And you bring up, a great point then with regard to, the tools that are out there. What tools exist today in terms of trying to solve the problems that you're referring to, again, for those people that are involved in the trenches as far as how to come up with the data behind the financial reporting? What's out there? What resources do you see out there? You want to maybe add to that?
Sure. Yeah, I think some of them are chamber members and others are folks that we've worked with clients for years. So I don't mind saying who they are, but ultimately you've got two different sort of tracks. You've got the folks that are trying to address the tax needs, the gain loss reporting using algorithms. You've got the folks that are trying to address the accounting and tracking needs or general ledger needs. And so we're actually now starting to see a mix of those two, right? Because a lot of the issues are overlapping. So SoftLedger is a provider of an ERP that has a crypto focus and an open API capability, very powerful. Legible or Verity, Verity's Legible product has been trusted by a lot of folks in the industry for a number of years. Node 40 is a sort of more agnostic data solution, more focused on tax right now, but has a good algorithm. And then there's other folks like Gilded who have a really good mass pay solution. So, projects that want to pay in crypto or actually, use the digital asset to pay folks, they've got a good solution there as well that can integrate that payroll back into accounting very easily.
Where do we see maybe the future of what some of the evolution in the tools that can be available to CFOs and other folks at the operations side of a number of our members here? Where do we see that going? Any idea on that, or conjecture, Mike or Lizzie or Noah? Any thoughts on where that might be transitioning in the future?
From my perspective, I think it's only going to get more complex. We have an industry that is moving so quickly and innovating so quickly. Making sure that the data on the back end is there to support as you're scaling a business is really important to deal with both tax and accounting. So, I'm seeing a lot of people having to do it, really build themselves and make sure they have the right data in-house. And they have the right ability to query that data, understand it, and manipulate it. So I'm seeing a lot of things in-house, but it only gets more is getting more complicated. So staying up with the data side is going to be really important for the industry.
Great point. Yeah, I mean, again, Mike, I think it drives the need to seek those resources out, and it frightens you and I to walk into a place with a spreadsheet, right? Noah, what do you see? This is your area expertise here, and I know you're involved with this every day. What do you see in terms of the evolution of the?
Yeah, I'm uncomfortably close to this problem. Yeah, so I think as digital assets make their way onto more and more balance sheets and onto balance sheets of non-crypto native companies, right? Companies that didn't originally build their business model around a digital asset. You're going to see these accounting needs grow as they grow for larger and larger or mid-market and publicly traded companies. You're going to see the software providers in the space see the opportunity to address the problem. So you're going to start to see the largest ERPs, add decimal places for crypto, add reporting, add outside API type integrations so that they can obtain blockchain data or obtain pricing data from from trade venues. So yeah, I think it's going to be a maturation of the accounting space and a maturation of the software accounting space at the same time. Ultimately, it leaves me with the abiding feeling that we are still very early, and it's exciting stuff.
Absolutely. We're running into our last couple of minutes here, so I thought take just a couple minutes as far as each of you have any closing thoughts or comments. Lizzie, why don't I start with you? I'll put you on the spot.
Yeah, absolutely. Yeah, totally. And thanks for having me. With going off what Noah was just saying, with that expected trajectory, let our office be a tool for you guys. Reach out to us, connect with us. Your expertise really helps us, understand this space and see what we can do from our end to, achieve a better accounting framework. So we'll keep fighting, however we can, but your input is so valued to our office. So reach out, and I'm looking forward to connecting with, any and all of you.
And we appreciate all that you've done at this point, and again, what you're proposing there. Mike or Noah?
I guess I'd say to echo on what Noah said, it does feel still very early, but it's really exciting to be at the early stages, have the ability to kind of influence how these systems get built, influence the accounting, so that these business models can grow and can expand. So we're at the early stages, but a lot of the existing standard setters really want to hear from industry. They want to hear from industry on what the challenges are and how we can make this better and how we can grow the industry.
Great.
Yeah, reach out to someone.
Last but not least, there.
Accounting. I was just going to say, reach out to someone that you trust in accounting, because once you set down a course and you're developing financial statements and reporting, you've chosen methodology. You want to make sure that you're relatively comfortable with that going forward, right? These businesses are scaling quickly. We've seen a lot of public offerings, even, right? Reverse mergers or SPAC type transactions. So these things happen quickly in crypto. And if you're an operator, an entrepreneur, you want to prepare yourself for having the accounting side of the house in good order. Well
put. Thank you. Well, again, thank you each of you for your participation here today. We really appreciate sharing your expertise, with the members of the chamber, and appreciate all you do for the industry. So again, thank you to both Michael, Noah, and Lizzie for your participation today. And with that, we will hope that everybody continues to advocate for the digital asset arena, and again, continue to move things forward. So again, thank you.
Thanks, Dave.
All right.
Thanks so much.
Bye.